Mine? Never mind. Good afternoon. Welcome to I don't know how many these we have had, Eldon, or I don't know, fourth or fifth Eldon Rood Housing Forecast event. Mike, I could hear some echo on my voice through Eldon's speakers. Maybe mute while there we go. Well, welcome everyone. Thank you for being here. My name is Tiffany Stillwell. I'm the Vice President of Marketing at Patten Title. Just a little bit, and then we're going to jump right into Eldon's message. I know everyone is anxious to hear. Eldon, this is the most attendees we've had yet. So interesting year, right? First of all, just a little bit about Patten. I've been with Patten Title now for over 15 years. Patten started as a fee office, and we made the jump 2 years ago to becoming Patten Title Company. It's been an eventful 2 years, I think, for a lot of people in real estate, where we have more than doubled in the last 2 years. We have over 80 employees throughout 6 offices in Texas. We also have our own title plant. Our very well-staffed title plant with the veteran examiners and processors, and our title plant is they are speedy. I know, are getting title commitments out probably faster than anyone else I would compete against. But I think you all customers can expect a very fast turn time. And as you know, our escrow staff, if you jump it to the next slide, or actually, I guess I need to do that. We have fantastic escrow teams here in Austin, veterans with many years of experience, Mr. Mark Bean and his team, Miss Lacey Warren, and Miss Josie Garcia. And if we have not had the opportunity to close with you recently, we would ask for that opportunity and that privilege, and I know you'll be impressed with our teams. One more thing I want to point out about Patten is we really aim to be your true partner. I know the landscape has changed significantly over the last year, and we've all adapted. And I think it was coming, but it expedited the process for your closings to become remote or mobile many times. And as your true partner, Patten Title covered the expenses on nearly $500,000 of the mobile notary fees last year. It was a challenging year for everyone, and that was just one thing we could do to help with that challenge. And so it's interesting because I know realtors used to look for the nearest title company, and you don't need to do that anymore. You can look for the best title partner, and we would love that opportunity. So now, I get the great privilege of introducing Mr. Eldon Rood. So Eldon is one of the industry leaders, as everyone knows, and Eldon will tell you many times today that he doesn't have a crystal ball, but I tend to think he does because his predictions in the past and his insights have been pretty spot on. Eldon grew up in the Houston area. He attended the University of Texas and then became one of those UT graduates who never leaves. He is the founder and principal of 360 Real Estate Analytics. And prior to founding his company, Eldon served as director of Metro Studies Central Texas region. At Metro Study for nearly 17 years, he worked closely with the firm's builder, developer, and lender division. Prior to that, he was a partner at the Aegis Group, and he had obtained his MAI designation in 1990 and practiced commercial real estate appraisals for 20 years in Austin and San Antonio. In doing my research, something I learned, Eldon is an avid sailor. And his company is sprinkled with nautical references from the Compass Degree 360 to his blue and white business cards. At the same time, he has said 360 also represents his goal to provide complete, comprehensive, and sound real estate intelligence. Eldon is very generous with his talents and gifts and time, and he has served on the Home Builders Association of Greater Austin. He's been involved with the Austin Board of Realtors and many others, from the Real Estate Council of Austin, Urban Land Institute, Texas Association of Builders, I-35 Corridor Growth Summit, Austin Mortgage Bankers Association. The list is longer, but I know we are ready to get to Eldon's questions. So we are, let me see, I need to stop screen sharing so Eldon can screen share. Oh, thank you, Mike. Okay, a few housekeeping issues before I do turn it over to Eldon. We do have some questions that many of you submitted in your registration, and I will be posing those at the end. We're going to let Eldon go through his entire presentation, and then we'll take questions from the audience, which if you look at the bottom of your screen, there is the Ask a Question button, and I see one in there already. We also have one poll, and we will share the results of that, and you can see how your peers are doing. And then there is one call to action, which is if you would like to try our Patten title calculator, I encourage you to do that. It can be extremely helpful to you on the fly, or showing your sellers various options of their seller net sheets, of buyer cost estimates, and of your title calculations. So a couple tools for you down at the bottom. So without further ado, thank you all for being here, and I am going to turn it over to Eldon.
Great, Tiffany, thank you. I'm going to assume at this point, since all I have in my office is a computer screen, that everything is working and you guys can hear me and you can see my screen. If you can't, I'll know about it pretty quickly, I imagine. Well, thanks, Tiffany, and thanks, Patent Title, for the invitation. Are we good? Okay, all right. Mike says we're good. To be with you guys, I guess now this afternoon. Previous times that we have done this, not I guess last fall, but previous to that, we've been over at the Alamo Draft House in Miller. I think all of us probably much prefer that format. I know that I do. If nothing else, I get free popcorn when it's done, so that's always good. All of us are Zoom fatigue, WebEx, Microsoft Teams, whatever it is, and I know you like me are probably really looking forward to spending a lot more time close to the people that we do business with and the people that we love as well. So that said, we're here to talk about the real estate economy and especially our housing market. I have had a lot of conversations over the last 3 weeks as I prepared for my meetings with my retainer clients, which are primarily builders, bankers, and developers. So in addition to looking at a lot of data and statistics, I've heard a lot of stories like you guys have, and like you guys have been creating, if you will, the last number of months since the middle of May, when things really took off. And I think we could say that pretty much every story that you hear about the Austin housing market in terms of this intensity is true. There's probably one every once in a while where you have to consider the source for that story, whether it's true or not. But for the most part, every one of them are true. Before I dive into kind of the economy housing thing, I will say that especially doing business with bankers, that not necessarily all real estate areas or sectors are performing as incredibly as housing. If you are a lender or a developer or a property owner or an operator of a bar or a restaurant or a hotel or a catering business, businesses that involve close touch proximity to people, your business is probably not so good. I think we all recognize that's temporary, but all of that is kind of played into what's going on with housing. So I'm going to start with kind of a recap before we head into some of the statistical stuff, if you will. Just some highlights. I mean, what a year it was. We all knew that 2020 was going to be a strong year for housing because December of 19 was strong, and usually December is kind of slow. And then the year started out in January and February of 2020 were really strong. The builders were busy, the realtors were busy, there was a lot of activity. Pandemic hits in March, and for 30, 45, almost 60 days, the lights just went dim and none of us really knew what was going to happen. Certainly there was a lot of anxiety and fear, and it made sense. And then the market began to react some and turn to what was going on before the market surge in May. And what was really interesting to me as an analyst is the different reactions that the builders and developers had to the pandemic. And there were consequences to that. Some builders, especially on the production side, got conservative. They closed their sales offices, they pulled back, they pulled out of land purchases, they pulled out of lot purchases. Other builders remained very aggressive. And the consequences were that once the market took off in the middle of May, those builders that got conservative never caught up. And they certainly were kicking themselves late in the year for dropping some of those lot or land deals that they decided to let go during the initial weeks of the pandemic. The builders that remained the most aggressive in their marketing and still pursuing land opportunities during the pandemic were the ones that were the big winners, if you will, as the year wore on. Certainly, incredible opportunities showed themselves as 2020 evolved after May in terms of sales opportunities, especially for the builders that were poised to sell because they had inventory and lots. But with those opportunities came a lot of challenges, and that's what I'll talk probably more about today than anything. Builders, when I asked them over the last couple of weeks about 2020, and I asked them, based on what you had planned on selling in 2020, how much above plan did you do in terms of sales? And the typical response was somewhere between 20 and 30%, sometimes 40, meaning that they sold 20 to 30% more houses than they thought they were going to in 2020. And that was great, but it also meant that they had to start and finish and deliver those houses and close them. And so production issues and materials issues and labor issues became really large as the year went on. And then probably the biggest one are challenges with respect to land and lots. They ran out of lots, and we'll talk a lot about that as I move through my program. And then, we're not the only city, but Austin certainly is one of those Sunbelt cities that last year became kind of, in a strange way, a beneficiary on our housing side of what went on during the heat of the pandemic. And that especially is true with respect to this transformation in especially the tech industry, where people were working or are working at jobs in other parts of the country, especially the West Coast, that suddenly realized or recognized they could live anywhere. And Austin is one of those cities that they have chosen to move to. You couple that with the technology companies continuing to grow here in 2020. So you had people moving here to take a job in Austin. You had people moving here from other parts of the country that work somewhere else. And the combination of those two, coupled with people fleeing density, really played into the amazing demand levels we've seen for single-family housing over the last 8 or 9 months. And then you add to that the corporate relocation announcements that I'll talk a little bit later, and it truly has been a remarkable time. So that said, I'm going to get in the weeds a little bit here. I won't pretend to be a PhD economist, but just some kind of highlights in terms of the U.S. economy and kind of factors that have played into the resiliency of our economy over the last 8 or 9 months since the pandemic started. No doubt the U.S. government printing money and the huge stimulus. It was about a $2 trillion stimulus package last March or April. Obviously, there's another large stimulus package on the table. None of us know at this point where this is going to lay out. There's a lot of negotiating going on. But suffice it to say, there will be another package over the next couple of weeks that will put money certainly in the pocketbooks of people that need it today and tomorrow, to pay their rent and to feed themselves, but in their families. But I think we all also recognize that as part of that stimulus, especially the first one, we'll see how the second one plays out, that there were stimulus dollars ending up in the bank accounts of people that really still had jobs, and they weren't using that money to go on vacations, but they were using it either to save more or spend on housing projects, whether it be remodeling or buying a larger house. So we'll just have to see how this next stimulus package plays out. I'm going to show you two graphs here that represent two different periods of time, and I think that they shed a little bit of light on why we're seeing so much economic activity in Austin with respect to job creation here in the higher paying sectors and other parts of the country. So this first picture basically shows you annual change in jobs in the U.S. economy in the month of March. And I highlighted manufacturing, financial activities, and professional business services. All losses in March. No surprise, the big losses, education, health services, and leisure and hospitality. We know that. Fast forward to December, manufacturing, strong growth. Financial activities, some growth. Professional business services, strong growth. So I'll talk in a few minutes about Austin and these particular categories. And we've seen growth in those categories in Austin and around the country. So some of this job creation, especially in professional business services nationwide, a lot of those are technology jobs, and some of those people being hired in other parts of the country, especially in the big tech centers on the West Coast, especially. Those people decided, yeah, I'm going to take that job, but I don't have to live in San Jose or San Francisco or Seattle or Portland. I'm going to move somewhere else, whether it be Nashville, Raleigh, Tampa, Atlanta, Denver, Phoenix, or Austin. And certainly we've seen some of that here. Another big factor in terms of kind of wealth creation and confidence for people in income levels that are buying houses has been what's gone on in the stock market since the low point at the beginning of the pandemic. I'm only going to show one index because this is obviously the big tech index, the NASDAQ, up 100% almost from its low of March 23rd to January 8th. I'm not going to get into the gyrations going on in the equity markets right now because to tell you the truth, I don't understand some of them, but just on the baseline, when you think about the major tech companies that dominate the NASDAQ and the S&P, 5 of them, only Netflix, do not do business in Austin and have economic presences here. So certainly this increase, this wealth effect in the equity markets on the technology side has people made them more confident and more emboldened financially, and that plays into what we do for a living in terms of housing. We continue to say this over the last couple of years, but what more can you say about mortgage interest rates in terms of their impact on demand for housing? Again, every time I'm preparing for my meetings with my clients and groups like you guys, I have conversations with a lot of builders, a lot of developers, a lot of bankers, realtors, engineers, etc. And as I was talking to my builder customers a few weeks ago and asking them, what were the key elements and why you guys and ladies sold so many houses last year? And at least the top 1, 2, or 3 responses, every one of them mentioned low interest rates. So it's no doubt that with rates dropping so much since the beginning of the pandemic, we brought a lot of people into the market, enabled them to buy that otherwise could not have purchased a home. And we certainly provided a lot more buying power to those either that were looking to move up in terms of price or more in terms of house size. So big factor. I'm not here to predict the direction of interest rates, but everything that I can read, and I imagine you guys' sentiment is similar, points to remaining a low interest rate environment as we move through this year. It sounds like the Fed is dedicated to that. We all know at the same time that if rates were to spike, that it would certainly have a negative impact on the housing market. But it doesn't look like that's going to happen anytime soon. The 10-year is up a little bit the last few weeks, which you'd think would have some impact in terms of pushing rates a little bit higher. But as we all know, if you go back and look at this graph, historically, they're very low. So all of these factors, renewed job creation in the technical higher paying sectors in the economy, people fleeing density, work from home has spurred a huge increase in the demand for housing, not just resale, but obviously on the new home side. This graph shows total permits going back many years, and you can see the permit number up about 11% nationally in the last year through November. And the growth has been all over, especially in the West. The Census Bureau breaks down the U.S. into 4 large regions in terms of housing permits. And you can see the South, Midwest, and West were all up over 10% in the January to November 20 compared to the previous year. It's kind of interesting You read some articles out there about some of the coastal tech markets, their housing markets suffering some because people moving out of those areas. But if you look at the suburban markets outside of Seattle, Portland, San Francisco, and San Jose, they've been very strong. So people moving out of the urban core areas to the suburbs, kind of like Austin, but obviously we don't have nearly as much density as those cities do. So suburban areas in those areas in those markets doing well. All right, a quick look at the Texas economy. So what you're looking at here is basically a picture of annual job growth by year for year end 2018, 19, and 20 for the four major metropolitan areas in Texas. No surprise, all of these markets show job losses in the last year. As I'll show you again in a minute for Austin, most of those losses concentrated in education, healthcare, and leisure and hospitality. All these numbers were worse in April, May, and June, meaning more losses than now. Austin's almost break even in terms of the job numbers now. No surprise, Houston, more losses than DFW. The economies are about the same size, but more oil and gas layoffs in Houston certainly than DFW because Houston is such an oil and gas heavy city. San Antonio, no surprise that they have a little bit more losses than Austin. The economies are about the same size because of their greater reliance on tourism and hospitality in San Antonio. So all these markets had job losses in the year ending December 20, but at the same time, all of these markets had pretty strong housing markets in 2020 for the same reasons that we're experiencing strong conditions here, meaning people fleeing density, moving out of apartments, moving out of urban core, low interest rates, and people working from home, and people moving from other parts of the country to the Sun Belt. And obviously all of our cities, major cities, are Sun Belt cities. That said, none of the markets have experienced quite the dynamics that we have in terms of extreme imbalance in supply and demand for housing, but all of them had pretty strong years. All right, let's focus on Austin a little bit. So even in the midst of a global national recession and technically a recession in Austin, we continue to get major economic development wins in 2020. And a lot of it has to do with the continued momentum and migration of companies out of areas with very burdensome tax structure and regulation. And obviously California being the top of that list. The big announcement last year certainly was Tesla. I don't know if you've driven by their facility under construction along 130, pretty amazing. They're already quite vertical there. Oracle's announcement that they will move their corporate headquarters to Austin. You know, they already employ a lot of people in Austin over at their facility off of Riverside. So it might be that we don't see a lot more people moving here from Oracle, but just the fact that they have decided to leave California in terms of their corporate headquarters is just one more momentum creating event of not only an exodus from California, but a movement to Austin. And other companies and people pay attention to this in terms of where they want to locate their corporate offices. And certainly it has a lot to do with where their people want to live. And we're not the only city that is seeing this influx. Certainly a lot of the other Sunbelt cities are, but we're near the top of the list of a lot of these companies moving. This was a chart put out by the Chamber a couple of weeks ago. It actually has November to November data. But what they did is they ranked the best performing metro areas in the U.S. relative to their job markets in the last year. All of these markets have lost jobs in the last 12 months. Austin has lost the least as a percentage of total employment. And you look at this list, and it is not the large gateway markets like New York or Boston or San Francisco or LA. It's dominated by Sun Belt cities and cities where tech companies are growing and where their young workforce want to live. Kind of interesting. I'm going to show you a couple of pictures here that can be kind of complicated, but I'll try to make it easy here. In looking at the job numbers for Austin in the early months of the pandemic, they really they didn't tell us much about why we're seeing such strong demand for housing here, because all the categories we saw some losses in the first part of the pandemic. But as we got through the end of the year in December, which these numbers reflect, I think they began to paint a picture of what's going on, at least help paint a picture. So what you're looking at is annual change in non-ag job growth by category. And the BLS, the Bureau of Labor Statistics, breaks down jobs into 10 primary categories. And you're looking at the first 5 on this page, and then I'll show you the next 5 on the next page. The red bars represent 2020. So when you think about construction jobs in Austin, that's the big component of that grouping there, positive. Manufacturing jobs in Austin, we're a tech manufacturing town. We're not a manufacturing town like they are in the Midwest. So when you look at that red bar relative to the last couple of years, which were strong years for growth in tech manufacturing, that's a big number. These numbers get revised in March by Workforce Commission, so they might be revised down somewhere, somewhat. But at the same time, you look at that, that's a positive for us because those are higher paying jobs. And I'll go tangent a little bit here. I think we've all been reading that it is very likely that Samsung is going to build a new fabrication facility on the property they just bought to their existing facility on Palmer. The first couple of years will all be construction jobs, but ultimately those jobs that are professionals that are hired there will end up in that manufacturing category. Another win for Austin. Trade, transportation, utilities. So the trade jobs are a combination of retail trade and wholesale trade. I would imagine that retail trade jobs, we probably had losses last year, which means we had enough jobs to counteract that in wholesale trade, higher paying jobs. Transportation, we know there's a lot more jobs in transportation because of how many Amazon, et cetera, trucks we're seeing move around. Information systems, not sure why that one is negative because that includes some technology jobs. Financial activities, that is a huge number in the last year. I would suspect it get revised down, will be revised down some in March, but still, that's a big number. All the jobs tied in with what you guys do financially related to the real estate market, whether it be mortgage or title, are in those categories. So imagine that's part of the reason for the increase there. And then the next page, most significantly for our economy, is professional and business services. So remember I talked earlier about the U.S. going fairly positive in terms of job growth most recently in this category. The number that you see there is consistent with the total jobs we've been creating in that category for the last 10 years, even though it was negative the first couple of months of the pandemic. So a lot of the higher paying technology jobs in Austin are in that category. And so you look at the next 2 categories, no surprise, that's where the losses are. Government down some, I would imagine that's because of natural attrition in some of the governmental entities recognizing they're going to have budget shortfalls the next year or so because of the pandemic. So going back to professional business services, the overall unemployment rate for Austin is 5.1. I would imagine that it's higher for education, health services, and leisure and hospitality, think bars, restaurants, and hotels, which means it's lower for professional business services, which means that those jobs are having to be filled by people moving to Austin. So you couple those people moving here for jobs that are Austin jobs with growth in that category in other parts of the country where people have now decided they're not going to live on the West Coast, they're going to live somewhere else, and some percentage of them are coming here. So I think the data kind of gives us a little bit more explanation on the job front than it did 6 months ago in terms of why we're seeing such strong in-migration into the area of people moving here to either take a job or a job that they're doing somewhere else and they're living in Austin. Just one more piece of information that kind of plays into the attractiveness of our market from an investment standpoint and why we're seeing, especially on the land side, so much interest in Austin. The Urban Land Institute, a national think tank organization, global really, they have a survey of their members, which are builders, developers, investors, etc., every year. and they asked them a series of questions about where they are interested in placing their investment in capital the next year. And this survey was done in the fall of 2020. And I'm only going to show two categories here. The overall category of attractiveness in terms of investment for overall real estate prospects. Austin has been number one, I think, the last couple of years. This year we're number two. And then you look at the cities on that list. And again, Boston's probably the only gateway city on there. Long Island, I guess you tie it with New York, but San Francisco's not on there. Seattle is not on there. Chicago's not on there. Portland's not on there. Dominated by Sunbelt cities. And then home building prospects, we came in number two. Again, look at the cities on that list. I mean, a lot of cities that are Sunbelt where tech companies are growing. And so when these survey respondents ranked the cities, they were thinking population growth and job growth. And so they all are looking to us, as well as some other cities on that list, as cities where they expect to see significant growth in population and jobs in 2021. All of you saw this ranking that came out from Zillow a couple of weeks ago. And it looks like the core methodology they're using is expectations in terms of price increases for homes. And I'm sure that's directly related to inventory levels relative to job growth and population growth. And they expect Austin to have the most extremes in those categories for 2021. And then you can see the other cities, all Sunbelt cities except for Denver. And then those expected not to perform as well. Four of those, the top four, are all coastal. I won't spend too much time on this, but just to kind of a little comment on the office market. We've been building a lot of office buildings, and we're putting a lot of space on the market. And the reality is that since the pandemic started, big users of office space are pausing. They're not executing leases at this point because they're not sure, one, when it's going to be safe for their people to come back, and two, they're not sure exactly what the office environment is going to look like in terms of density once they do. So as a result, we're seeing more space be delivered than we're occupying, and two, big users of space, some of the big tech companies are putting some of their space back on the market as sublease space. So the result has been a higher vacancy rate. And it's kind of interesting from a housing perspective is you have these companies that are hiring here, and you have companies that are hiring elsewhere, and their people have elected to move here. But obviously, we all know they're not going to the office, and they're all working from home. So even in the midst of this period with a slower office market, it plays right into what's going on in housing in terms of people wanting more space, home office, two home offices, and why we're seeing so much activity, especially in the suburbs. The industrial market, completely different. I mean, with the explosion of e-commerce, huge demand for industrial space, and when you have a very strong housing market, a lot of companies that do business supplying the housing market need industrial bulk warehouse space. So very different market from industrial to office. Obviously, some of the other sectors hurting as well in terms of bars and restaurants and hotel. All right, let's move into housing. So the first thing we'll talk about is the apartment market. So as you guys know, we've been building a lot of apartments during this cycle. We have been occupying most of them because so many people have been moving to Austin before they buy or living in apartments for longer durations. But over the last year or so, as a few less people have moved to Austin, as people have moved here and decided not to rent first, they're buying first and bypassing renting, and the fact that some of our core markets have lost tenants or people renting apartments to the suburbs, we've begun to see a slight decline in rental rates and occupancies over the last couple of quarters. We're still building a lot of units, and the suburban markets are doing fine, but some of the core markets have suffered some. So what you're looking at here is a map that shows pretty much the main four core urban apartment markets. And this is data from Austin Investor Interest that shows the change in occupancy and rents in these four core areas from the fourth quarter of 19 to the fourth quarter of 2020. And again, a couple things going on. So you have people that are living in urban apartments, especially downtown, with elevators, tight, closed spaces, where people have been moving out and electing to either rent an apartment suburban or they're buying, whether it be resale or new. And so as a result of that, we've seen a decrease in occupancy and dropping rents in some of these core areas. We're still building units there. And then the other factor that's playing into some of the softening in these core markets is that companies that lease apartments for their employees who are traveling are not renewing as much because their people aren't traveling. And then two, entities that lease apartments to release them to people that are staying here short-term, vacation, etc., are not renewing either because obviously there's not as much movement of flow of people into town that are here for leisure purposes. So as a result, some of the core urban markets obviously softening some, and I would expect the market will continue to soften some as we add more units until people, companies, etc., feel comfortable again living downtown, living in some of these urban areas in larger numbers, and comfortable with elevators, etc. I think this is a temporary thing, but until people feel comfortable, it likely endures. Again, we've added lots of apartments the last year. We have a lot of apartments under construction, about 24,000. We're going to complete another 13,000 the next year. I think the suburban markets will probably do fine because we continue to have flow of people into town and people wanting to live suburban, even if it's apartments. But some of the urban areas, in terms of the apartment market, probably suffer some. All right, let's move into the real meat of the housing market in terms of new and resale. I touched on this a little bit at the beginning, but I'll take a little bit deeper dive here. Now I'm going to break down kind of the market dynamics into demand and supply, and I'll start with demand. So as I mentioned, in addition to looking at the data, I talked to a lot of people in the market, especially those that work for builders, whether they be the division presidents, the sales and marketing folks, or the land teams. And every year in January, I ask them about what their thoughts are for the next year in terms of sales. And certainly while most of them over the last couple of years have been very optimistic, there's always a few who have some reasons for concern in terms of sales or certain submarkets or price points or products or whatever it might be. But as I had my conversations over the last few weeks, no one I talked to had any concerns over sales levels to start the year, the first few months. They had such a strong end of last year, such low inventory that they all felt really comfortable that the first 2 or 3 months of the year or so were going to be really strong. Allocation of sales. I mean, that's kind of the buzzword among the builders as they move through 2020. Because of challenges in terms of meeting production expectations, because of challenges in terms of low lot supplies, many of them in their most active subdivisions were allocating sales each week, each month, to keep a steady flow of production, to maintain a lot supply. And obviously that's resulted in a lot of really frustrated prospective buyers coming into sales offices and being told by the salespeople to come back in a month or 2 months that they have nothing to sell them. Again, very low inventory levels, as you guys know. I'll show you some stats on that in a minute. Typically, December is the slow month for sales for builders. Typically the slowest of the year, not December of 2020. In some of the conversations I had with some of my builder friends, one builder that does, one of the larger builders in town, they do probably 1,000 units a year. He told me they expected to sell somewhere around 75 homes in December. They sold 250. Another comment for a builder that does about 600 units a year. This was the week before the snow in Austin. He said that they had more appointments that next weekend from prospective buyers coming to their models than they'd ever had in the history of the company. Traffic levels are huge. And another really interesting part of the demand side, all of us in the industry, and you guys, I'm sure, in 2017, 2018, 2019, we're talking about the increase in pricing of homes in Austin relative to income levels. And I showed graphs every time I was speaking to groups, especially in 18 and 19, that Austin's multiplier of home price to incomes was increasing at a rate we hadn't seen before. We certainly weren't anywhere near the coastal markets, but we were moving above all the Texas markets, certainly. And all of us know that we've seen structural increases in pricing for homes since May of last year. no one's talking about pricing being an issue in the building side. Now, that's not to say they don't have to structurally be consistent with their competitors in terms of pricing for similar products in similar locations, but they're not meeting resistance on the pricing side. I mean, all of them have raised prices significantly in the last year, partly because of the increase in lot pricing in home materials, but part of it's because they've been able to capture more profit as well. And they're trying to slow down sales in some communities, so they raise prices. As an analyst, I would rather see 2% price increases into perpetuity because it just allows for more orderly market movement, but that's not what we're seeing now. And as you guys know, on the resale side, we'll talk more about that, just the fanatical pace of activity and multiple offers on homes. So demand at this point, as of yesterday, no issues. And the constraints and the challenges are all on the supply side. Several builders in the market that are some of the biggest builders, they have moved to a completely spec strategy. So they're not selling any dirt sales, no pre-sales, all specs, which has reduced their risk in terms of what that house might cost to construct. It's made it easier on their salespeople because they don't have to worry about people coming in, buying a house, and worrying about changes that are made during the contract process. They're just going spec. Other builders, especially in the move-up market, have huge backlogs of homes. I mean, some of the builders I talked to, they've already sold half their year in terms of what their plans are for sales for the year, and they haven't started the houses yet. So they have huge challenges in terms of getting those done. Delays in construction, as you guys know, material shortages, prices for materials continue to go up. Lumber went up significantly the first part of 2020, and then it dropped down towards the fall, and now the prices doubled again in December. So more risk. Labor issues for all the builders, just general labor supply issues when you're building more houses and the labor pool hadn't changed in size, and then certainly issues related to illnesses from COVID affecting several of the labor pool as well. And then at the end of the day, the basic raw material that builders need to build houses, lots and land. I know I'm going to say this several times during my presentation this morning, so I'll say it one more time here. I have never seen a structural increase like we've seen in the price of finished lots and raw land that we've seen just in the last 7 or 8 months. Builders becoming increasingly aggressive in terms of pricing, short feasibility periods, how much cash they're putting down, just intense competition among the builders for lots, and intense competition among the largest builders and developers for land. So land in far out suburban, I say it's far out, in suburban areas where we're doing most of our home construction, structural increases in pricing. And as all of you know, when a lot price goes up, when the land price goes up, ultimately it plays right into the price of the house going up too. And we've all seen sharp increases in prices for homes, obviously, in the last 6 or 7 months. Just kind of from a production standpoint, the total permits for the region in the 12 months ending in November, 20,700. The start number came out the other day. It was 21,000. I would imagine the permit number will be, the year-end number for December will be about 21,000. Just a ho-hum 15% increase from a year ago. That was not expected. And it's interesting that when you look at the numbers, that builders could have certainly started more houses if they had capacity because they sold more houses in 2020 than they started. Some of you probably saw this list. The John Burns Consulting Group puts out a summary of the top master plans in the U.S. every year. And typically we might have 1 or 2 in the top 33 or so. This year we had 5. Santa Rita Ranch, 640 sales. Santa Rita, as you guys know, up in Liberty Hill off Reagan. Sonterra is in Gerald, 632 sales. Gerald is north of Salado, south of Temple. Sunfield down in Buda, almost 600 sales. Easton Park at the eastern edge of William Cannon Drive in southeast Austin, almost 600 sales. And Larkspur up in Leander, 570 sales. A community in Austin that is considered really successful historically in terms of home sales is somewhere around 300. And all these were nearly double that. Some of you have probably seen video that's been going around that in the builder community from Santa Rita Ranch a couple of weeks ago, where there was a new section of lots being introduced in the Liberty Hill School District portion of Santa Rita Ranch North, and some people were camping out overnight in front of the model home. And the video was of the morning they opened the model. There must have been 50 or 60 people in line to go in and put a contract on the model there. Or not the model, the new section of lots that had opened. And it made me think of Phoenix and Southern California in 2005 and 6. I was just astounded. We do a survey of a number of production builders in the market every month. We have about 25 builders that participate, and they provide us information every month on their traffic units and their sales and their inventory levels. And so I'm going to show you a few graphs from our survey for the last couple of years. The green line represents 2020, and the blue and red lines represent 2018 and 2019. No surprise, big drop in traffic in March and April, then things picked up. You'll notice that the traffic numbers were pretty consistent for the rest of the year, but what was not consistent was sales. And the reason is that buyers and builders pivoted very quickly to much more of a virtual interaction with buyers, whether it be touring the model homes or the whole contracting process, and as typically referred to, all the closing process as well. So about the same amount of traffic, but big jump in sales all through the summer. The numbers dipped a little bit in the fall, and the reason is because of lot supply and production issues, not demand. And then you can see December, a big spike in December. And part of that was related to the fact there's no resale inventory. And so as buyers get frustrated on the resale side, they know if they go to a new home sales office and they are selling houses, that if they put a contract on a house, at least they're going to get one at some point in time. So if you look at the year as whole, overall gross and net sales about 30% above what we did last year. Huge increase. And as I showed you a minute ago, the start number is only about 15% above last year. So that tells you that we have more sales than starts, which means a big backlog of sales going into 2020 or 2021. The spring market in Austin is typically started in March. That's when we sell the most homes. I think we can kind of throw that out the window. This year, the spring market started in May of last year. Pretty amazing. And then the other side of the equation is inventory. So we have 30% more sales. And the question we asked the builders for this data point here is, how many homes did you start spec this month in your subdivisions? And so this is the summation of all. So we're selling 30% more homes, and we have significantly less inventory under construction. And then the most alarming statistic is how much finished spec inventory. So we asked the builders, how many homes did you start spec completed that aren't sold? And of these 25 builders, there were 67 units in that category at the end of the year. And a year ago, that number was 600. So when you drive a subdivision of new homes and you see a house under construction right now, it's sold. If you see a house that is finished and no one's moved in, it's probably closing tomorrow and somebody's going to move in soon. Or it might be a bust out, but it's probably under contract already. It's just so little inventory. So when you couple this level of inventory on the new home side, less than 0.6 inventory on the resale side, you can see why things are so tight and why prices are going up so quickly. The resale numbers, I won't get too into the weeds here. I think this is probably the most telling statistic in the resale market is months of supply of inventory. So typically, we look at 3 to 4 months as tight, and we've been below 3 to 4 months since 2013. And that's why we've seen prices go up. But over the last number of months, as you guys well know, the situation has gotten much more extreme, where we finished December, I think, with a 0.6 months of supply of inventory. And as you guys know, I imagine if we went into MLS and we said, okay, I'm going to take out all of those active listings that just have stupid pricing, meaning it's pricing that the house is not going to sell because of the price, that level of inventory that was real and price to sell would probably get down to 0.5 or 0.4. Amazing. And when inventory levels are this low, we're not going to see just price increases that we typically see. We're going to see spikes in pricing. And that's what we saw last year. And you guys have seen some of these stats, and I'm sure you've run one of these stats for certain market areas that you're active in. Big increases all over the market, especially those closer into Austin. Average price, and to get this calculation, basically I take total gross dollar volume of sales for the year, divide it by the number of sales, and then compare that to the previous year, and that was up 11%. The median is a month-over-month analysis, as you guys know, so the median price December of 20 versus the median December 19, up almost 16%. And that would move around a little bit based on the distribution of sales at any given month, but still, that's a big number. Just for grins, I went in a couple of weeks ago to MLS and said, okay, how many houses are for sale in each price range? Broke it down into, I guess, 6, 1, 2, 3, 4, 5, 6. And then I said, how many homes sold in the last year in that price range? And what's the months of supply? And as we all know, you put a 3 or 4 in front of those numbers, and that's pretty tight. Every one of them except above 750 had less than a 1 month supply of inventory. And again, you guys know this, and that's why we're seeing spikes in pricing. Just to kind of touch on some of the core areas, I went in and looked at change in median pricing for the 9 years from 2011 to 2020, and then just calculated 2019 to 2020. 1A, kind of Northwest Hills-ish, up 16% in the last year. Lake Travis North and South up 14, Eanes up 13, and then core Central Austin median price up 18%. Pemberton, Terrytown, Balcones up in that area. So when you think about new homes being constructed in some of these close-in areas on lots that already have houses, that spec in these core areas just got a lot more expensive because that lot just went up significantly in price. Looking at just kind of the luxury market, and I do this pretty much once a year, just kind of take a look, and it's pretty amazing this time as well. Basically, I went into MLS and said, okay, show me all the active listings. This was a couple weeks ago in these 4 price ranges above 750. And I certainly recognize that there's a certain amount of inventory, especially above 2 million, that doesn't get listed. So it's not on this market. So I'm just using what's listed, if you will. How many homes sold in that price range in the last year? That's the red bar. And then in that yellow box is the corresponding months of supply. And then a year ago is in that black box. And all those below 2 million a year ago were tight. And now what we're seeing is ridiculously tight. There's just no inventory. And then this is just for new construction. So I took out all the to be built. So this is the blue bar is what's under construction or what was finished new construction in the recent months. How many sold in that price range in red, and then the month's supply in yellow, and then a year ago in black. So telling us what we already know, but most significantly, as I look at it, is more reasoning and justification for why we're seeing the big spikes in pricing, is demand relative to supply. The downtown condo market, a couple comments on that. I looked at this last fall because I was kind of curious as to what impacts the pandemic has had on the downtown condo market. And when I looked at it in September, you really couldn't see it much in the data. And so I looked at the same data set a few weeks ago, and then I followed that up with some conversations with some realtors that deal exclusively downtown. And you guys probably know some of this, but I'll say it anyway. Most of us recognize that the buyer group downtown for condos, not apartments, but condos, is typically more affluent. They're typically a little bit older. And a lot of them are interested in the lifestyle downtown. They could live anywhere given the pricing. And so they have enjoyed and continue to enjoy the lifestyle of all the young tech workers downtown. The bars are full, the restaurants are full, it's fun to be down there. And then you think about what happened last March. And all those tech workers, for the most part, are gone for now, temporarily. They're at home. And so that lifestyle picture changed downtown for all those folks that are living downtown. Those that I've talked to, especially the realtors, I mean, they certainly bring up the homeless population downtown, which is kind of interesting because there's a couple things going on there. Certainly more visible, but probably just as significantly as a percentage of the people that you see downtown every day and every night, that population has gotten much greater. So just kind of the vibe and feel for downtown during this period with young people not there has changed. So what that has resulted in is a little bit more challenges for people that are selling condos, whether they be existing or what's under construction. But also it's important to remember that a lot of people that own condos downtown, they're not forced to sell. So it's not like a situation where they have to. But those that did elect to sell last year in summer and fall basically faced a little bit longer marketing period. So I went in and calculated days on market for these projects, the 12 months ending August 21 versus January, or actually August 20, that's a misprint, August 20 versus January 21. You can see, except for C-Home, a little bit longer marketing period. And then according to some of the realtors down there, those that did elect to sell last year had to drop their prices around 10% from what they thought they were going to sell their units for. The good thing long-term downtown is ultimately those young people will be back. They'll be back officing downtown. I'm not saying they're going to be there as many days a week, but as the tech companies continue to grow downtown, which they are, there'll be even more people downtown than there were 10 months ago, ultimately. And things will change relative to kind of the landscape again. And there's not a significant number of condos under construction downtown now. There's more apartments than anything. Finally, a couple price index, just to remind us of the increase in pricing in Austin in the last 9 months or so. And this data just goes to the third quarter. This is FHFA price index. This is just for Austin. This compares Austin to Texas and the U.S. No surprise, the spike we've seen greater than Texas in the U.S., even though prices up overall around the country. This compares us to Dallas, Houston, and San Antonio, all of which had pretty good housing markets last year. Austin, the strongest. Austin compared to Atlanta, Nashville, Raleigh, Charlotte, all of which had really dynamic markets in the last year post-COVID because, again, people fleeing density, interest rates, and people moving to these Sunbelt cities out of coastal areas. But Austin above all those in terms of appreciation. Austin compared to Denver, San Jose, Portland, Seattle. As I talked about a little bit earlier, the suburban markets for these tech areas have done well. It's the urban markets that have suffered. But Austin not typically having appreciation rates above these heavy tech cities. Again, I'd rather see us at a much more moderate rate long term than seeing these spikes because I think it opens us up for potential issues on the other side of the curve. And to wrap up my comments, looking forward, I mean, as you guys already know, and I can already see from the data I'm seeing as well as my conversations with my builder and realtor friends, just a blistering start to 2021. The builders have really high bars for their sales, especially public companies, because if they sold X number of units in 2020, their corporate groups expect them to sell more houses this year. Builders are going to continue to gap out of lots in their most active communities because in many cases they sold homes on lots last year that they thought they would use this year. And so they're scrambling to try to find lots to accommodate that growth. We're going to continue to see builders allocating sales, at least in this environment. If it endures, we're going to see increasing lot and land prices. And when a lot price goes up, there's a 5 times multiplier in the production world for lot price to home price. So when that front foot price of a lot goes up, the home price is going to go up. Entitlement and permitting issues continue to be a big challenge for the builders and developers. When you think about the fact that pretty much all city and county employees are working from home, a system that already was not completely efficient just got less efficient. And so the builders are facing really long permitting times, and the entitlement periods for land is only getting longer. And then with so much production, and so many houses being built, and prices going up so much closer to town, builders and developers are certainly continuing to push geography further out to try to find land opportunities where they can bring on lots and still meet that kind of meat of the market, which at this point is in the low 3s, kind of the first-time housing, hard to believe, but true. So we'll see more activity in Taylor, more activity in Northeast Georgetown, more activity out in Eldon, more activity further east from Pflugerville, more activity along 21 east of Kyle and Buda, down to Lockhart, San Marcos. Certainly we'll still see a lot of activity west, but it's just so expensive to buy land and get utilities and title west that we'll see less of it, although there will happen to just be less of it. And to wrap up, just to remind everyone, someone asked the question, and I know I'm going to get a few of these in the Q&A, can this go on forever? And my response would be absolutely not. That said, we know it's really strong now. There's so many people out looking that haven't found what they want yet, that's going to carry momentum, certainly through the first part of the year. There is no history book. There is no playbook that we as analysts can look to in terms of, okay, here's how things finish up in terms of a pandemic and when it's over. Because so much about people buying houses is tied to psychology. And people are emboldened, they are confident, and they feel a sense of urgency right now. And so many young people have decided in the last 6 or 9 months that suburban is okay. Space is okay. My friends are buying suburban. I'm working from home now. I'm not going to be commuting as much. And so it's been an interesting test case of human psychology in terms to watch this young cohort of people that have been delaying everything, whether it be married or children or buying a house, move forward, especially in terms of buying. And again, you have this compilation of people coming from out of town and people taking jobs here that has really fed the marketplace. With that, I will pause and I'll turn it over to Tiffany for any questions you guys might have. I appreciate your time, and hopefully this has added a little morsel of insight to some of you as you do your businesses.
Great information as always, Eldon. I've seen some questions about getting this presentation after the event. If you look right above Eldon and I, you see the title of this event on your left, and on your right is the Patten Title Company, and then follow. If you follow us on this Crowdcast platform, very soon after the event, you will see this recording, and prior event recordings will be there as well. So that's one way you can get a hold of that right away, and we will also be emailing it out. All right, Eldon. Oh, Eldon's muted. Go ahead, Eldon.
Well, I was saying, I hope no one has to go through the pain of listening to me again, but that's okay.
They want to. Okay, far and away, the number one question for you, Eldon, had to do with inventory. So I'm going to put all of it together if I could. Kind of when do you see inventories getting better, leveling out, being more supply for the demand that's out there? And the second part of that question is, what areas are the most poised for growth and which ones will struggle the most?
On the inventory question, I'm going to give kind of a macro answer to that. I mean, one, and probably for some of you guys, decades of being involved in analyzing the housing market, we have never seen this low level of new home or resale inventory. And so as long as the intensity of demand remains at this pace, we're not going to see significant easing in inventory. That said, all of us recognize at some point in time, we'll begin to see an easing, if you will, in terms of this intense level of demand. I mean, we're probably seeing people buy now that otherwise might have purchased a year or 2 years or 3 years from now. So some of that intensity or some of that level of demand or some of those numbers will slowly kind of go away over time, even if the economy remains strong. It'll take a while for the builders to increase their capacity. And so until that happens, it's going to be very tight, I think. And then ultimately, and I think you guys all know I'm about to say this, what will really result in inventory levels coming back to normal and likely going past normal will be the next period in terms of our economy when things slow from the standpoint of the overall global U.S. economy slowing. So I wish I could say, we're going to move back into this really nice level of just enough inventory to satisfy everybody and prices going up very slowly. That's not the way it works. I mean, the reality is that the next time we look up and go, there's plenty of inventory, we're not going to have as many buyers as we do now, and we'll be worrying about other things. So, it's going to stay really tight for now. But I expect that this flow of people from other parts of the country will begin to wane a little bit as the pandemic eases, later this year, early into next year, but it's still going to be tight. Was areas of growth. As I talked about a few minutes ago, for the builders in particular, the vast majority of them on the production side, they're trying to meet demand somewhere in that $300,000 to $500,000 price range, and it's really hard to do that west of 35, and especially west of, as you move west of Mopac. And so most of their interest in terms of bigger builders will be far north, think Ronald Reagan, all the way up to Georgetown, and then moving east along the 130 corridor out to Taylor, east of Pflugerville, east of Manor out to Elgin, although there's not a lot of utilities between Manor and Elgin, out 21 towards Bastrop, along 21 and 183 going south down into Mustang Ridge and Uland and Lockhart, and down towards San Marcos. So think east, because that's where we build 60 to 70% of the houses in the region, because that's where the builders can hit a price point that's a little bit lower. So that would be my best answer to that question.
A little while ago, and I live in Rancho Siena, not far from there, and I received an email from a realtor, I sent it to you the other day, calling this area Tech Corridor. Have you heard it called that? And there's nothing up here except an HEB being built.
Well, I haven't heard that particular area being talked Tech Corridor, Tiffany, but when you think about the tech companies that have located further in off of McNeil and Palmer and 183, and the fact that Apple's got the second piece of their facility under construction. And then when you think about home prices in that immediate area, it makes sense that a lot of the people that are working in those areas and will be working in those areas are going to commute up into Leander, Cedar Park, and Liberty Hill, and already are. So I can see why they call it that.
There was a question about the condos, and someone just wanted clarification. You were saying the downtown condos price drop has been around 10%. Is that accurate?
Question. So in my discussions with some of the realtors, they indicated that if someone who owned a condo downtown wanted to sell in April, May, June, July, August, September, in that period, they generally had to come off their pricing around 10% relative to what they thought they could sell for based on the comps that were there for earlier. That said, the folks I talked to on the realtor side, they felt that things had gotten better in December and January. There was a little more optimism in the market. And obviously, all of us are beginning to kind of look months ahead and see a light at the end of the tunnel, and that things had gotten a little bit better. So that was mostly correct, but I'm glad I could fill in a little bit of color there.
Yeah, I had an agent tell me they kind of suspected people didn't want to get in elevators anymore during a pandemic. And so, and the homeless population, like you mentioned. Good question here on how will the exit of the forbearance option on mortgages affect our market locally?
I think that it won't be significant here when you think about how many professionals we have in our market. We don't have a huge manufacturing sector here in terms of the wages that the manufacturing metropolitan areas have. I think the issues, there will be some, certainly as it relates to some of the service industry population that own homes. But at the same time, it's likely that, and we've proved this in previous down periods, that the recovery is quick enough and strong enough in our market, and that there are other job opportunities available in Austin for some of those folks that have been in the service industries, that it's not as big a deal here as some other parts of the country that have lower wage scales and larger unemployment numbers because of their reliance on manufacturing and other service industries. That would be my thought.
Okay. Well, I think we've just about covered it all, Eldon. And we're a little bit over time, but great information. Wow, what a year, right? So we'll see you back maybe in about 6 months.
I'll be paying attention, and you guys are going to be, really busy for a while. So continue good luck, and I wish I could paint a picture of a lot more inventory in the next 90 days, but I think it's going to remain tight because so many people are still out there looking.
Yes. And to answer one more thing, to update everybody on the poll, the final thing, compared to this time last year, is your business doing better? Almost 93%, yes, doing better. About the same, 3.6%, doing worse, 3.6%. So definitely the vast majority of you are doing better. So thank you everyone for attending, especially Eldon. Thank you for your wisdom and insights. We appreciate it. Happy 2021, everyone. Stay safe. Bye-bye.